Hey guys, it's Sasha. In the last 2 months, Tesla stock has gone up 100%. In the last 4 months, Palantir stock has gone up 200% after already going up 200% in the previous year. Bitcoin is up 500% in the last 2 years, but this insane stock market rally does not stop there. The S&P 500 is up about 30% so far this year after already going up 26% last year. And the euphoria on social media is deafening. People inside the echo chambers of all the different tech company fan clubs are patting themselves on the back, wildly celebrating. Every day that their favorite stock goes up another 5%, everyone is egging each other on, celebrating this as some sort of a personal achievement. Everyone is a genius in a bull market. If you bought any of the popular stocks, literally any of them on YouTube, on social media, you just pick any of them, you will probably be up 100%, maybe 400%, maybe more. And this sort of success breeds arrogance and overconfidence among investors who feel that their unique strategy, their brains, their reading of technical signals is the reason why their portfolio is so green. Stocks are going up in a vertical line, and everywhere you look, investors are popping champagne, declaring victory as though they somehow personally are responsible, or they perfectly predicted one of the biggest bull runs in stock market history. The increase in stock market valuations is being driven almost entirely by an increase in multiples. There has been no meaningful increase in this time in outputs or in profits, but the multiples that investors are assigning to those profits have taken off in a vertical line. A lot of investors say that inflation, or the value of the dollar, explains why valuations have skyrocketed. But that argument just doesn't work, because if inflation was the reason for valuations going up so much, so fast over the last 2 years, then company profits would also be going up at the same rate. Since March 2023, forward earnings per share grew by 18%, while the price of stocks is up 45%. This increase in stock valuations over the last year and a half has been sharper than during the clown market in 2020 and 2021. If you are in doubt as to the precise level of degeneracy in the stock market right now, we have Tesla investors celebrating that the stock hit $420 a share, because this is a number that is related to smoking pot. We have Palantir executives tweeting that they changed the stock to trade over on the Nasdaq exchange from the New York Stock Exchange so that it would deliver tendies to investors. And the stock went up 10% on the day that happened, which is of course extremely rational behavior based purely on stock fundamentals. Forbes is writing about Nvidia stock heading for a $10 trillion valuation. That's another 200% from its valuation today, after it has already gone up 1100% in the last 2 years. Nvidia's revenues and profits have exploded in the last 2 years because of the demand for its graphics cards from AI companies, and there is now an expectation that Nvidia will continue growing those revenues at the same rate or perhaps even faster, and Nvidia will continue being able to sell those cards at 6 times the profit margin of what those cards made back in 2022. The expectations on the future performance of tech companies are now so high that the Shiller-PE ratio has passed the peak in 1929 and the peak in November 2021, trading only to the insufferable valuations of unprofitable .com startups in 1999. And the issue here is not so much the absolute level of the valuations. There are plenty of investors out there who continue being invested in tech stocks because they think that there is still more upside remaining from the current share price. Tesla is the biggest position in my portfolio, so I can tell you that I'm very much not suffering from FOMO here. Even though I already know that the legions of keyboard warriors from stock fan clubs will descend onto the comments section to tell me that I am salty, I missed out, I profess their strategic superiority through being invested in a stock that has gone up 3 bazillion% in the last 2 years. I have the popcorn, I am looking forward to it, do your worst, but no, the problem is not really in the absolute values necessarily. The real issue here is the speed at which the market has made this new determination and the reason for that speed. The increase in Shiller-PE ratio in the last 2 years is the sharpest we've seen on record, and part of the reason is because the Shiller-PE ratio takes the last 10 years of profits into its calculation, and the 2020 crisis will be included within that data, when profits slumped. And now that the world is over the pandemic, valuations reflect a very different expectation of the future, while the denominator continues to include that big drop in profits from 2020. The The Schiller PE ratio takes earnings over that 10-year period, but here is a chart of the trailing PE ratio for the S&P 500, which takes just the last 12 months only. And on the surface, it looks like the PE ratio is not as high as it has been before. But if you look closely, you'll notice that the big spike in 2008 came because company profits collapsed. The valuations didn't go up, company profits collapsed faster than stock valuations fell. So the ratio of the price to earnings spiked as a result of that. And the same exact thing happened in 2001 and again in 2020. So if you exclude the spikes that were caused by massive stock market crashes, massive crashes in profits, and even if you then zoom right out, the PE ratio at the moment is the highest it has ever been, except that blip in 1999 just before the dot-com crash, and it's climbing. And you could argue that over time there is a natural trend for valuations to move higher, to move towards higher multiples. But that doesn't really explain why the stock market has suddenly right now decided that a stock that had a PE ratio of 60 in the summer should have a PE ratio of 120 right now, or why another stock that had a PE ratio of 100 in the summer should now have a PE ratio of 400. When nothing about those stocks, nothing about the performance of those companies has really changed. I know that every company always has news, has something coming up soon, some new products coming out in the next quarter and 2 quarters time and all that. And I know that there will be fanboys in the comment telling me that their favorite company is special. This time is different. There is some unprecedented news that completely justifies this sudden explosion in price. You just don't get it, bro. But if you're honest with yourself, if you take off the rose-tinted spectacles, nothing much has really changed since August, while all of these stocks have been exploding. We've had Robinhood stock explode up around 400% in the last year. MicroStrategy is up over 500%, even more than Bitcoin, because MicroStrategy has essentially become a leveraged Bitcoin investment vehicle, because literally nobody who invests in MicroStrategy cares what the company actually does. Even boring stocks are blowing up. Walmart is up 84% in the last year. United Airlines is up 130% after going up in a vertical line. Banks like Capital One and Bank of America are up 50% in the last year. It is almost impossible to not make a return in the stock market this year, regardless of what you're investing in. Look, even Meet Kevin has made money. His small PP ETF made a 6% return, while the S&P 500 is up 30% this year. Bitcoin is a speculation-based asset. There is no specific fundamental reason why it is ever trading at any specific price, other than the consensus of the market. There is no specific reason why today, for example, Bitcoin is worth $100,000 as opposed to being $10,000 or $1,000 or $1 million or maybe $1 trillion. The value is determined by traders speculating up and down on every single day trades, but there is no underlying assets. There is no underlying business, no underlying profit, no PE ratio. So at least Bitcoin gets a pass at being priced whatever the traders feel like. The problem in the market at the moment is the speed at which stocks are gaining in price, because extremely high price velocity going upwards indicates the market is in a state of euphoria and acting irrationally. I already know the comments that you'll find below this video, but Tesla has FSD version 13 now, and Tesla is launching a new model in Q1, that's the reason. But Elon Musk is besties with Donald Trump, and yeah. So did the entire market sit down in the last few months, take on some new data, rebuild their valuation models of every single stock in the stock market based on all this data, and come out with a valuation that is 2 or 3 times higher? Or did they not do that? Well, the answer is no. Some people will say that for the last 2 or 3 years, some of these companies have been sold off. The share price was lower than it was at the peak of the insane clown market in 2020. So it was just recovering from the downturn in stock market prices. Now, I understand the V-shaped recovery when it happens like it did after the 2020 crash. People immediately go and realize that maybe they overreacted. The stock market goes right back up. So did the whole stock market sit down 2.5 years later after crashing at the start of 2022 and decide, you know what, it's been a while, so it's time to go and recover, like right now? We all do it at the same time. Yeah, you go, we all go at the same time. And then they go right back to the top of whatever they were before the 2022 crash. Let's just go and do it. Well, no, that's not what happened either. The fact is, the last few months in the stock market, are extremely unusual. The return in the market over the last 2 years is the 5th best 2-year period in stock market history. 3 out of the 4 times above this last 2-year period happened just before a huge stock market crash. The Wall Street crash of 1929, the 1937 recession during the Great Depression, and the dot-com bubble. The 4th one did not have a major stock market crash. The market only fell 10%. Now, the issue with these types of markets is you can never tell when the market is going to revert. You know it's a bubble, you know it's going to pop, but you go and sell now, and the next year the market has another 30% return year before diving, and at the very bottom of that crash it might still be above where it is today. Or the market could keep on going for another 3 years, like back in the 1990s. And if you miss out on the big gains while sitting around waiting for the crash to happen, your portfolio is going to suffer. So what do you do? Well, Warren Buffett is cashing in stocks that have run up and sitting on an ever-growing pile of cash. That's one strategy if you can't see stocks that you think are good value in the market. If you are an index investor, timing the market is even more difficult because an index doesn't tend to go up 1200% to a P/E ratio of 500 in the space of a few months. So it is a little less clear there where you might want to go and buy in or sell out, and getting your timing wrong is significantly more likely. If you get your timing wrong and you miss out on some of the strongest months when the stock market goes up, for example the next few months, that can be the difference between getting a great return or getting nothing, or even getting a negative return in your portfolio. The tried and tested method of doing nothing is mathematically the most sound strategy for most retail investors, if you look at data going across history. But with the market running this hot, a lot of investors are going to have very itchy fingers.